Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In this episode, we're going to tackle a question you all have emailed me about many times, and it's this. Should we have international stock funds, ETFs or mutual funds, in our portfolio? Or should we just stick, with U.S. stocks, whether it's a S&P 500 or perhaps a total stock market? And let me just give you an example of one email I received, and they said, thank you for all your wonderful work. It's greatly helped me as I transition from working to FIRE, that's financial independence, retire early. I have compared the two-fund portfolio, so that would be just U.S. stocks and U.S. bonds, with the three-fund portfolio with the 70-30 mix in Portfolio Visualizer. And just as an aside, the three-fund portfolio would include international stocks. They go on, help me with my analysis. It appears that the international fund causes more volatility, less returns, and a higher downside. Am I looking at this correctly? Thanks. So it's a great question. And the last thing we want is both more volatility, less returns, and a higher downside. I mean, that's, that ain't good. And so the question is that right? Have international stocks performed so poorly, number one? And number two, if that's true, why in the world would we ever invest in international stocks? So here's what we're going to do. We're going to look briefly at the Portfolio Visualizer and see how the returns have played out. We're also going to look at current valuations using Morningstar. Then I'm going to give you what I think are some really compelling reasons why we shouldn't invest in international stocks. And then at the end, I'm going to tell you why I nevertheless do. So we've got a lot to cover, so let's get right to it. And let me begin with Portfolio Visualizer. Show it to you on my screen here. I've already sort of pre-populated this. What I've done is I've got two portfolios. The first one here, Portfolio 1, is just the three-fund portfolio. It includes, as you can see right here, 30% of international stocks. And then a second portfolio just gets rid of that 30% in international stocks and puts it up here in the U.S. stock market. That's it. That's as simple as can be. When you analyze it, Portfolio Visualizer gives us data back to 1987, so we're looking at over 34 years. And here are the results. There are the portfolios, and as you can see, the Bogle head three-fund portfolio that includes international stocks significantly underperformed a two-fund portfolio that put everything in the U.S. stock market. 10,000 grew to 191. For the portfolio with international stocks, 290. For the fund without, you can see the compound annual growth rate. And also the standard deviation, a measure of volatility, a little higher when you exclude international. Although when you look at the worst years, they're actually a little worse with the three fund, and the max drawdown is actually a little worse with the three fund portfolio as well. So when we look at this, boy, that's pretty tough. I mean, it certainly suggests that international stocks have not helped that much. Now, one of the things before we move away from comparing the performance, I always like to add a scenario where we're contributing money, because this, I think, mirrors what you and I actually do in our working years. So I'm going to add $250 a month, adjust it for inflation. Let's rerun the numbers. Still probably going to be in favor of no international. It is. It's a little closer. Of course, we're dealing with a bigger final balance because we were contributing $250 a month. And there's still a big difference, about 400 grand. Although when you look at the compound annual growth rate, well, 1% or 1.1%, it's a big deal. And there you see it. So still no question, if we exclude international stocks, we will have done better. Now, the other thing I like to do, and we're going to remove these contributions for a minute, I like to look at decades. And let's start with the current or most recent, we'll say from 2011 to the present. And we analyze this, and we're going to see, no international stocks significantly outperformed the three-fund portfolio. And now, however, let's go back another decade. We'll go to 2001 to 2000. We'll just say to 2010. And now we'll look at it again. Well, now there's a different story. Of course, that period of time, we saw two significant bear markets, right? The tech bubble burst and then the Great Recession. So the compound annual growth rate wasn't great, but it's actually higher for the three-fund portfolio, and if we include international stocks. All right, so that decade, international stocks helped. Let's go back another decade. And if you're a stock market historian, you know that this decade was quite good for U.S. stocks, so they should prevail. And sure enough, now the portfolio with no international stocks does notably better than the portfolio that's got 30% international stocks. And then before we leave this, let's just go back one more decade. There's a point to all of this. Here we go. The 80s, probably international is going to win. Let's see. Yeah, international won. Again, not by a lot, but compound annual growth rate of 16.3 versus just under 14. So what that tells us, if we take the whole time period available to us in Portfolio Visualizer, not having an international exposure helped us. When we look at it by decade, it varies. The last decade, international didn't help us. The first decade of the century, it did. The 1990s didn't help us. The 1980s, it did help us. It's like, okay, now what do we do? Well, we'll get there, but that's the data. Now, I want to show you, before we move into the reasons why I think you might exclude international exposure from your portfolio, I want to take a quick look at Morningstar. If we look at, say, we'll look at Vanguard's total stock market ETF. So this is an ETF that covers the entire U.S. market. If we look at the portfolio, we can see that it has a price to earnings of about 21. Now that is a forward-looking price to earnings. So it's using estimates of what they think the US market will earn next year for the earnings portion of the ratio. Now let's compare that. Remember, that was 21. Let's compare it to an international fund. This is Vanguard's sort of global fund, excluding the US. How does it compare to the 21 for US stocks? Well, you can see here it's significantly cheaper on a PE basis. We could look at the price to book, it would be similar. But the point is, international stocks on a, say, price to earnings evaluation are significantly cheaper than US stocks. And the same would be true, by the way, if we focus just on emerging markets. This is the Vanguard Emerging Market Fund. I own this fund. And if we look at the PE, yeah, it's even cheaper, 13. So what do we have right now? Long-term international stocks don't seem to help us. They can help us, though, over, say, a 10-year period. Depends on which 10-year period we look at. And as of valuations today, 2021, international stocks appear to be significantly cheaper than U.S. stocks, at least on a price to earnings or price to book basis. So having said all of that, keep that in mind. I want to kind of go through the arguments of why you might want to exclude international stocks from your portfolio. All right. Now, to be clear, I'm talking about funds that invest in companies that are headquartered outside of the United States, right? All right. The first thing I want to point out is that two legendary investors, Warren Buffett and Jack Bogle, have both indicated that they'd be perfectly comfortable excluding international stocks. Warren Buffett, kind of indirectly, of course, he's a big fan of the U.S. He does invest in companies headquartered overseas. But when he was asked, how should the average investor invest? His answer was put 90% in an S&P 500 index fund and 10% in short-term U.S. Treasuries. And I've done a video on the Warren Buffett portfolio. It does not include any international stocks. And the same is true with John Bogle, the founder of Vanguard. He did an interview with Morningstar, and I will link to all of this below the video. But he did an interview, and he was often questioned about this. He just felt that there was no reason to have direct international exposure. He was perfectly comfortable leaving all of his money in U.S. stock funds. Now, that's fine to a point. The question, though, is why? And there were a number of reasons that he gave and that others have given. And the first kind of core reason from his perspective was, look, the United States is simply the best place to invest. We have a very entrepreneurial spirit. We have very sound institutions. You think financial institutions, governance. Obviously, a developed government. Not, obviously we have our issues like any country, but certainly when you compare it to many, many countries in the world, we're pretty solid as a place to invest. He points out we also have a very diversified economy. It's not as if we're reliant completely on, let's say, travel or agriculture or commodities of some kind, mining, for our economy. We have a well diversified economy. The other thing that he points out, and others have as well, is that U.S. companies do business all over the world. I mean, just think of Apple or Microsoft. These companies do business all over the world. They generate revenue in all kinds of currencies and in all kinds of markets. In fact, when you look at sort of the U.S. Public market, roughly 50%, in some cases I've heard 40%, but a pretty significant percentage of both revenue and earnings come from abroad. So even if you're just investing in the S&P 500 or maybe a total stock market index fund, you're getting significant exposure to business all over the world. Another reason is that many have started to question just how well diversified or how much diversification international stocks really add to a portfolio. It seems, at least when we have a bear market, something happens and stocks go down, they tend to go down everywhere. It's not as if international stocks have given us great diversity. At least that's the view of some. There's even a Morningstar article, and again, I'll link to it below the video, but they concluded that actually, if you want diversity, there's something that's actually better than international stocks, even better than specifically emerging market stocks for diversification. What is it? U.S. small cap value, oddly enough. So many question the diversification benefits of international stocks. And I think sort of a final reason is that there are many countries that are politically or economically unstable, or both politically and economically unstable. And trying to avoid those environments are pretty difficult, particularly if you're just going to put your money in sort of a broad-based index fund. You're going to end up investing in places that may not be very friendly to investment, certainly not as friendly by and large as the United States is. So I'll be honest with you, even though I invest in international stock funds, and I'll explain why in a minute, I find the arguments to the contrary to be somewhat compelling. I mean, these are certainly very notable arguments that many very excellent investors have made in the past, not just John Bogle and Warren Buffett, others as well. And so I think they deserve serious consideration, and I've given a lot of thought to them. Now, having said all of that, I am still a big believer in having some exposure to international stocks. Why? Well, the first reason is, yes, the U.S. has been dominant, certainly economically, in many ways. I'm not convinced that dominance will last forever. In fact, I don't believe it will. I'm not the kind of person that believes the end is near for the United States and its dominance. But things don't last forever, and I think we can fool ourselves into thinking that they do. And I want to share with you something that will give you an example of that. This was actually in the last Berkshire Hathaway meeting, and I'm going to pull a couple things up on the screen. Let me show you this first slide. This is a slide that Warren Buffett put together. He talked about it at the last Berkshire Hathaway meeting, as you can tell from the slide. I think that's about as big as I can get it. But these are the 20 largest companies by market cap, meaning the value of their outstanding shares in the market, as of earlier this year, March 31, 2021. And you can see they range from $2 trillion for Apple down to about 36 billion for a company in France. But clearly, the United States dominates the public stock market. We've got 3, 6, 7, 8, looks like 13 of the top 20 companies, 5 of the top 6. Obviously, there are a couple of companies in China, Korea, Taiwan, but clearly the United States dominates the public markets when it comes to stocks. Now, my question for you is, I'm going to pull up a slide. What do you think the top 20 largest companies looked like 30 years ago in 1989? So I guess that's 32 years ago. Any idea? Any guess as to how many of those companies were headquartered in the United States? There were 13 today. How many do you think were headquartered in the United States in 1989? And how do you think valuations have changed? Well, here we go. Here's the slide. I was stunned by this. I started law school in 1989. Now I wasn't investing, but I was in my 20s. I had no idea that Japanese companies dominated, stocks as they did at that time. And you can see, they've got, it's almost like it's flipped. They were the United States 32 years ago. Now, that's the first thing. The other thing to look at is the valuations. The number one company then was valued at $104 billion. There are people worth more than that today. And if we compare that to the current list, 104 billion, the number 20 company is worth 3 times that. So capitalism has, really done an excellent job, if you will, over the last 30 years. But boy, have things changed. And so Japan dominated the top 20 30 years ago, and today we do. Will we dominate it again 30 years from now? I suppose we might, but one thing to keep in mind, if we go back to these lists, not a single company on this list from 1989, not one of them is on the list today. Not a single one of them stayed in the top 20, including, by the way, the companies from 1989 in the United States: Philip Morris, American AT&T, IBM, General Electric, Exxon. Of course, the companies continue to exist, some of them, I think, yes, but not nearly the same size, and didn't make, factoring in inflation and everything, and didn't make the list for the top 20 today. So I think things will continue to change. And my hunch is that 30 years from now, the list of the top 20 companies might very well not look like the list today. It probably won't. And it's possible that not a single company on the list today will be on that list 30 years from now. That seems impossible, right? Apple, Microsoft, Google. But we would have said the same thing in 1989. Exxon, for goodness sake, what could possibly happen that would bump Exxon off that list? And well, they're not on the list. So yes, we've dominated in many ways. And yes, we've dominated when you look at sort of the returns over the last 30 years. I'm just not convinced that we'll continue to dominate like that for the next 30 years. That gets me to point number 2. I prefer the added diversification for that reason. I recognize I'm taking a risk, if you will, that my portfolio will underperform because I have international exposure. But because I get that added diversification, I'm okay with that risk. I sort of couple that with the first point, that things change. And it seems to me that gives me some comfort. The third thing is, as I pointed out earlier, valuations are significantly lower for international stocks. Now, that doesn't mean they're going to outperform U.S. stocks. Sometimes a company or an index or a basket of stocks, they're valued lower for a reason, right? And it could very well, one could argue that the reason international stocks generally are valued less, they're cheaper than U.S. stocks, is because of the environments in which investment is taking place, and the political instability in some countries, and the economic instability in some companies, and just the general friendliness to capital and investment in the United States, even compared to other developed countries. That being said, the valuations are so significantly different today that I do take some comfort in the lower valuations that international stocks provide. Doesn't mean they're going to outperform over any given period of time, but if I were to gamble, if I were going to make a bet, my bet would be international stocks will outperform the U.S. Over the next decade. I could be wrong, but those valuation differences are pretty significant. Now, where does that lead me? It leads me to an international exposure of roughly around 20%, maybe as high as 30%. Probably wouldn't go higher than that. For me, I like to have a developed country or total U.S. or total international stock fund of around 15 to 20%, along with some direct exposure to emerging markets, no more than 10%, probably no less than 5%. That's my approach. Now, there's a final reason why I have international stocks. And I think as you make what you think is the best decision for you, I think this really is the most important factor. It's more important than looking at past data, current valuations, or arguments about the political and economic stability of a country. And it's this: what will you be comfortable sticking with for the long term? Because no matter which way you go, there are going to be times when your choice is underperforming the other option. It's true whether you include international stocks or not. There are going to be times when your choice is simply underperforming. And are you going to be able to stick with your allocation through both good times and bad? Frankly, I think that's probably the single most important question when you're determining any type of asset allocation. You're debating the 3-fund portfolio versus the 6-fund portfolio. The question you need to ask is, what's going to give you the most comfort to stick with your choice over the long term? And I think, frankly, I can stick with an allocation that includes international stocks, even when they are slightly underperforming a portfolio that doesn't have international stocks. I'll be more likely to stick with that than I would a 100% US stock portfolio if the US runs into some kind of trouble where we're significantly underperforming the world for some reason, maybe a reason you and I can't even begin to predict right now. So that, I think, a very significant consideration as you decide what's best for you. Well, there you go. There are the issues, the pros and cons of investing in international stocks as part of your portfolio, and why I make the decision that I make, which may or may not be right for you. If you have any questions, leave them in the comments below. Be happy to help you out any way I can. As I said, I'll have links to all of the things that we've talked about in this video down below. And until next time, remember, the best thing money can buy is financial freedom.